Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello and welcome to another Rogue Trader video, and today I'm doing a stock analysis update on Hikma Pharmaceuticals. Hikma are the third largest generic injectable supplier in the US and the 10th largest generic supplier. 60% of their revenues are based in the US, but they also have Europe and rest of the world at 7% of their revenues, and a third of their trade is in the Middle East and North Africa. I've already done quite an extensive video on Hikma back in November of 2020, and if you click on the top right there, you should be able to get a link to that. I bought Hikma back in November of 2020, and a bit of a lackluster performance. And in the last 4 months, the stock price has declined quite rapidly and I'm now 20% underwater. The discipline I hold myself by is that if my stocks go down in this value, I spend a lot of time assessing what's going on. And that's really the purpose of this video. So 41% of their revenue comes from injectables. And these are actually biosimilar products. So they're generic versions of the main marketed products, and because they are injectables, they are a very high barrier of entry. So this is a way that generic companies like Hikma can protect their future growth, their future revenue streams, by specializing in this more complex area. A third of their revenues came from generics, and then 26% from branded pharmaceuticals. These are the generic products that they are making anyway in the US and Europe, which they then can repackage as branded products to sell in the Middle East and North Africa. And I think it's kind of good that they get this force multiplier of being able to sell their products in another territory to top up their profits that they're generating in the US. There's a general bull case in generics in that the world population is growing massively, and the actual global generic drug sales are expected to increase from 75 billion to 100 billion by 2024. The population generally is getting older and wealthier, but also in the US, where most of their revenues come from, actually 17% of the US GDP is on healthcare. And as the American population gets older and a lot of the wealth is in the older population, we can expect there is a very good case for a general bull trend in the sale of generics in the US. So pharmaceutical companies are all about the research and development, which is the scientists in the lab developing the new products, the filing of those products with the regulatory authorities, then getting those products approved, and then actually launching the products. So I've been tabulating this data for Hikma. They have around 500 products in the pipeline. And we see that generally the trend is lower. In 2016, 2017, they were saying that they were deliberately releasing less generics to focus more on the injectables and more complex generics. So there's more of a quality rather than quantity thing going on. Overall, you could call this a neutral profile, but with some uptick in the last year. If you look at the core operating profit of these business segments, which is one of Hikma's main KPIs, you can see generally a good trend, particularly in generics, and the same with the core operating margin. Actually, the reason for this curve here with the generics is that in 2017, Hikma bought a company called Roxane to acquire a massive generics portfolio, but they then had to write down loads of losses related to that because it wasn't very profitable what was going on there. But after restructuring with this expanded portfolio, they've managed to increase the core operating margin of the overall portfolio. having digested the Roxane business. But you could perhaps say that the core operating margin is kind of stagnating now following this growth in just the generics area. So this is from the 2020 annual report, and then I've added some information from the 2021 trading update. And looking at the injectables, which is the most important segment really of their revenues, in 2020 there was growth in their injectables segment, and as per the 2021 trading update, this growth continued at 4 to 6% growth. Actually, in 2021 there was an 8% drop in the US market, but then in the Middle East and North Africa, Europe and rest of the world, there was actually massive growth which compensated for that. So what's positive with Hikma, with their injectables, is that they've managed to keep the growth even at a small rate in 2021, despite the COVID lockdown, meaning that patients couldn't really access the hospitals to get new medical treatment. And so we then go into 2022 expecting a real boost in growth here as people are allowed to go and see their doctors again. But then even this 5% growth on its own is a reasonable result. In generics, we had growth in 2020, and in their November 2021 trading update, they promised 10% growth in generics, so that's positive. And in their branded products, the 2021 trading update suggested a 4 to 6% growth in this segment. There's slight growth really in all areas, which is in line with expectations. And we're looking forward to a post-COVID boost in 2022. Looking at the long-term price trend, and it's tempting to draw a linear line here, and maybe these little diversions are just diversions from this general trend upwards, which gives us some cause for hope here. But I really need to try and understand this fall in share price, which really is the purpose of this video. So going back to 2017, and there's a huge product they've been working on, which is the Advair Discus. They've been working on a generic version of that. Now this is the actual GSK product, which they're making a generic version of. It's a 0.4 billion per year revenues product in the US. And as a complex product, once they've created their generic version of this, it's hard for other people to come in and then also create their generic versions and fight with them for the market share. They had their ANDA application rejected though, so that was bad news. But this dropping share price wasn't actually related to that. It was because they took over this Columbus business, and in 2017 they had to have some massive write-downs related to that. So they had a real bad year in 2017, and so that explains the drop in share price there. So they then got in a new CEO, Sigurd Olafsson, and then a new Chief Transformation Officer. And what's been going on is traditionally the company had been a family-run business by the initial owners, Saeed Dawaza and his family interests. These guys had been controlling the company with an iron fist, if you like, and they decided to change the governance of the company. So this guy has taken a seat back a bit, although he's kind of still acting as it, but now he's doing it more country club style, with these new directors coming in to manage the company. They hired Vectura to develop a Ellipta generics product. Ellipta is another massive inhalation project, and it shows their strategy to focus more on more complicated generic products to help maintain solid future revenue streams for that segment of their revenues. And their Advair generic product completed its primary endpoint study in 2019. In 2020, Boehringer Ingelheim upset the apple cart when they decided to sell their 16.5% stake in the company. So here's where I tabulate the shareholders. Boehringer had a massive number of shares in the company, 16.5% of the overall number of shares. And they decided strategically to move away. And so Hikma then used 295 million to buy 5% of those shares, which I think they hold in treasury. And they managed to find some other buyers in BlackRock Group and Wellington Management Group. But obviously, this is, this was a bit of a kind of unfortunate thing to happen because, that's a massive number of shares being offloaded. And it meant that Hikma, but in having to buy a load of those shares, that was £0.3 billion that they couldn't use in reinvesting in the company. So it's a bit unfortunate that happened. And I do wonder if some of this share price drop is maybe the aftershocks of this imbalancing of a major shareholder pulling out. Then in 2020, Gilead selected Hikma to do some contract manufacture of their remdesivir product, which was used for the treatment of COVID-19. So that was quite cool that they were selected to help do their bit in helping with the COVID crisis. And then in the later half of 2020, I did my first video, which I suggest you go and have a look at. And then I bought some Hikma at a price of £25.80p. So this was obviously bad timing. In early 2021, they released actually quite good results. Plus they announced that they were launching their generic version of Advair. Now that is actually a big news item. That's a very significant revenue generating product. Their half year results were good, as I've already outlined. But despite these good results, the share price has been in decline ever since. There was some news flow in the later half of 2021. First of all, they bought Custopharm for 425 million. Custopharm are a generic injectables company, and it brings in 13 products that they can sell, and also which perhaps they can turn into branded products for the North Africa and Middle East region. It only generates 80 million of revenue though, so it will take a long time for them to recoup that 425 million investment. Then they announced the launch of a 503B sterile compounding business. Now this is something they call specials in the UK, but essentially it's where they take it, where you can get a doctor to sign off, and you in a GMP area you can create new medicines from existing medicines using compounding in the right environment. But this is actually, it seems all a bit awkward, but it's a 2 billion industry now in the US. So it's a little bit racy. They are showing boldness in doing these things in order to increase their injectables revenues. And then only a few weeks ago, they announced that they'd just bought Teligent's Canadian injectables portfolio for 46 million. And this brings 25 injectable products into their pipeline. So looking at this exciting last 5 years, you can certainly say that they're a feisty company, and there's a lot of activity going on. They seem like they're working hard to increase their revenues, but still no solid reason for the drop in share price. I go in detail in the first video I did, but their revenue continues to grow. In fact, it's doubled in 5 years. And in their half one update, that trend continues. Interestingly, when I looked at the HSBC analysts, they're suggesting a real stagnation in their revenues. Here's the raw HSBC data. Yeah, and as we can see, their analysts predict a real stagnation in their revenues. But when you look at Hikma's analyst estimates on their website, their analysts, the analysts that they are pointing to, actually suggest quite incredible increases in their net sales. But certainly their trading updates for 2021 and their half-year results suggest an increase in revenues. So in the face of it, they are performing in line with expectations in terms of their revenues and their net income. And that's represented in their net income history. Obviously, this here is what went on when they took over the Roxanne business and had to digest that. And their core operating profits looking good. Their revenue by product class is looking good. And their revenue by geography is looking good. The assets I go into detail in my first video, but it's generally a good increasing trend in net assets. Their net assets have actually doubled in the last 5 years. Looking into the composition of their assets, and 24% of their assets are property, plant and equipment, and this is all their labs and factories where they're making these medicines. And then 18% of their assets are the medicines they've got in the warehouses ready to sell, with 18% of the assets being medicines that they've actually already sold and they're waiting for payment. So it really does look like a healthy profile in terms of their assets. Presumably that mirrors the case with other pharmaceutical companies, but it generally does look kind of healthy and transparent. And when you look at their market cap here, offlaid against their liabilities, they have a price to book of 2 to 1. And obviously, when you compare that with commodity and IT stocks, which I've been looking at lately, they look like great value. And actually, here I've got pharma stocks. These are all the FTSE listed large pharma stocks with a market cap of above 500 million. And you can see that Hikma are very well valued within their own peer group. This graph does make them look very reasonably priced. On my equity and valuation graphic, you can kind of see how they deviated from the usual trend in terms of the market cap as a multiple of the net assets and revenues. So maybe when I bought them there, that was where they were deviating a bit. But then to the same token, they can't really drop much further before the padding's looking a bit thin on this. But generally, it's a fairly reasonable profile, I think. So I've looked at the pharma sector, and this is only larger pharma stocks in the FTSE. And I did a little bit of tidying up of these anomalies here. And we see the general trend here mirrored against the overall sector graph for all biotech and pharma stocks. And we see that the general trend for pharma stocks has been an upward one, and it continues on this trend even now. So Hikma's recent drop is out of trend with this. And here we zoom into the last year, and we see that pharma stocks have been doing very well over the last year. And Hikma, you can clearly see a bucking the trend here. So this 20% drop in share price over the last year, this is out of sync with the rest of the farm industry, despite the fact that Hikma have provided growth. So here is the 2020 statement of cash flows, and they generated 464 million from normal activities. And when I broke it down into that, it really was generally a lot of that is from selling the drugs, not from complicated stuff. So that's a quality amount of cash coming in. They raised 171 million from their Euro bond. and they tapped 63 million from their revolving credit facility. And then against that, they spent 111 million on in-licensing costs. That's medicines that other people make that Hikma licensed to sell. And they spent 172 million on capex and 39 million on interest on their debt, with 9 million on miscellaneous. They paid out 109 million in dividends. And because of the things going on with Boehringer Ingelheim selling their shares, this forced Hikma into 375 million of share buybacks. So obviously the Boehringer Ingelheim problem is a bit of an anomaly. So I took that out and then assumed, well, if they didn't take on any debt. And then their normal business activities and these normal kind of expenses would result in a 24 million in cash. So their 2020 statement of cash flows were complicated by them having to do that massive share buyback. But when you just look at the usual state of affairs, it is a fairly healthy statement of cash flows. Their shareholding profile is a bit too interesting for my liking, because the Dawaza family own 25% of the shares. So their current executive chairman, obviously his father established the business, and the family still own a quarter of the shares through this Darhold Limited trust fund. The major shareholders of the Capital Group, Wellington Management and BlackRock, and I wasn't able to establish who owned all these shares, but it's mostly going to be large institutionals. When we look into the shareholders over the last few years, obviously when Boehringer sold their massive portion, it looks like Wellington and BlackRock took part in buying some of those shares. We know that Hikma also bought a significant portion of those shares as well. This is kind of uncomfortable. BlackRock then have been starting to sell some of those shares, and their latest sale was announced on the 12th of January. So this could explain the drop in share price, which I've not been able to explain anywhere else. Also, it's quite notable that the family owner there has been selling their shares in 2020. So that's obviously not very good. So their shareholder profile here is looking kind of negative. Boehringer Ingelheim had a 16.5% stake in the company, and when they offloaded all these shares, I do wonder if the aftershocks from that are being felt even now. There's not really anything else wrong with the company, and their performance is all seems to be in line with expectations. So I'd say that was really my best guess, but I can't really say honestly that I've put my finger on why the share price is dropping. So I've took a good look at Hikma because they're 22% down from when I first bought them. I force myself to do this whenever there is such a drop, as part of the discipline of making sure I'm keeping an eye on my portfolio. But the problem is I can't really say that I've put my finger on the reason why their share price has dropped. My best guess being it's the kind of aftershock from what happened when Boehringer sold a massive stake back in 2020, but that really is purely a wild guess. It's kind of important to me that their drop is out of trend with the general pharmaceutical sector, which, given that their growth is still okay, means it's something I don't understand. So I don't really want to rush into selling when I don't understand. But the main thing really why I'm going to hold is because Hikma are only 3% of my overall stock portfolio, and I'm only 19% in stocks anyway. So given that I've got such a defensive stock appropriation anyway in my overall portfolio, I want to veer towards being conservative and just not panic selling. And so I've decided I'm going to hold on to my Hikma. I'm generally bullish in the long term in the pharma sector. And also in 2022, We know that there's going to be a surge in people actually being treated in hospitals where they've been denied that treatment because of all the COVID stuff. So I really do feel inclined to hold on, even though I seem to be fighting against invisible forces. So I'm just going to hold on here again, and I've set another stop loss here of 20% from now. And if that happens, obviously I'll have to have a real long, hard look at them again. Plus, of course, if things change and I discover what's going on. But for now, I'm going to hold on to my Hikma, especially because they're such a small piece of the pie anyway. So risks that I'm tracking for them, with pharma stocks, you always have the risk of a major safety crisis and product recalls. The fact that the family own a quarter of the shares, that could be negative or positive if they end up selling out. The most important thing is, though, they've got to keep growing their revenues. We're relying on the post-COVID boost for that to happen, but that is a big risk to keep an eye on. So that completes my stock analysis update for Hikma. I hope you've enjoyed this, and good luck with your investing. Well, I just finished the video and I was in the process of uploading it when I just noticed that there was a new RNS for Hikma, an RNS that's only just literally come out. And what do you know? One of the major shareholders has sold 5% of the entire quantity of the shares in the company. So the culprit is the Capital Group companies. So they've halved, so Capital Group have halved their shares from 10% to 5%. And so this for me explains why the share price has been reducing despite all the fundamentals being good and despite the general sector of pharmaceuticals going up. This is the explanation of what's been happening here. And this news release just literally came out an hour ago while I was doing that video. So I'm sticking this now at the end of the video and then reprocessing the whole thing. But I'll still be just holding on to my shares. It's kind of a new situation for me. They've still got 5% of the company. So let's see, now that everybody knows what's been going on, maybe some others will step in at the cheaper price as we kind of now know the reason, or maybe everyone will start selling because they're scared that the Capital Group is going to sell the other 5%. But I don't know, we'll see. I'm just going to hold on to my stock. But it's great to now finally have an explanation of what's been going on. And I can't believe that this news item came out while I was doing that video. So I'm just sticking this on the end. And I hope you've enjoyed this, and a nice little bonus there for those of you that held on to the end of the video.